What is net strategy, and should you actually use it to pick stocks? Net strategy is a value investing strategy in which you try to find companies that are trading below their liquidation value. The strategy was developed by the economist Benjamin Graham, and it was also heavily used by his student, the legendary investor Warren Buffett, but he called it as a cigar butt strategy. So Warren Buffett called it a cigar butt strategy because he said these companies were like cigar butts. Nobody wanted them, and that's why they were selling so cheap. But then they still had last stock left in them, so you could still generate significant return because there was some value left in them, and they were trading below their value. With this strategy, you pick stock based on their net current asset value. So let's see how does it actually work. So in this strategy, you calculate net current asset value per share. And you calculate that by taking all the current assets, not all the assets, but just the current asset. And then you subtract total liabilities and preferred stock. And then you divide that by number of shares outstanding to calculate the net current asset value per share. So essentially what you're doing is you're looking at the net current asset available for the common shareholders. And then you buy stocks that are priced less than 60% of their net current asset value per share. Then you diversify your holdings, so you keep buying these kind of stocks till you reach the 30, minimum 30 stocks in your portfolio. And you do that because these stocks are so risky. You just don't want to stick with one or two stocks and then risk losing all of your money. You need to then review and rebalance frequently. So you should do it at least 1 year, at least once per year, just to make sure that whatever stocks you bought, if they have already realized their full value, then you can sell it. If they have been growing so much that they are no longer trading less than 60% of their net current asset value, then also you have to sell them. You can also use a more conservative approach, which uses net working capital. So in which you don't take the current assets at their full value. You assume that the cash and short-term investment you will be able to sell at the full value. You assume that account receivable you will be able to sell only at the 75% of the value. And you assume that inventory you will only be able to sell at 50% of their value. And then you subtract all of the liabilities. Does it actually work? So there have been numerous studies to find out if this strategy generates excess return. And most of these studies have found that this strategy is really good in that it does generate excess return. I picked up this table from the article link that I have given below in this slide. But read that article very carefully, and then you will realize that while it is possible to generate the excess return in theory, in practice it may not be that easy. So just go through that article and see for yourself that you will be able to, whether you will be able to apply that or not. In my view, it will be very difficult to implement this strategy while it is theoretically possible. So what are some of the limitations of net strategy? So one is that you can choose whatever stocks you choose, not all of them are going to generate a very good return. And that's why you try to diversify your portfolio by picking many of these stocks. The market is another thing is that market is much more efficient now with so much data available, with so many websites publishing all the data about all the companies than it was 50 to 100 years ago. And that's why it's very difficult to find these opportunities. And even if you find them, most likely they are so cheap for a specific reason. Maybe their accounts data is manipulated, or the owners may not even want to price the stocks rightly, but they might keep it low so that they can take it private. There could be many reasons, that these companies are priced so low. The another thing is that companies might keep burning cash and reduce NACV over a period of time. And that's why you should try to pick only the companies that are profitable. So that way, at least they are not burning cash and their NACV will actually increase over a period of time. This strategy is not suitable for long term. It's only a short term strategy in which you're just buying a dollar for 50 cents and you're waiting for the market to realize that. And the moment they are trading back a dollar at a dollar, then you just sell them. A bad management or a flawed business model can ruin a balance sheet very rapidly. So they might keep burning cash. Again, you can mitigate that strategy by picking on the profitable net strategy company. So as you can see, this strategy may not be as effective as it was initially invented. However, you can still use this strategy, and if you do find something that fits the criteria very well, then you can generate